In this video, we're going to be looking at some of the common ratio analysis that will be used by a common stockholder or somebody who might be looking to invest in a company and buy its stock. Investors are going to use ratio analysis to really assess the company's financial performance, to decide if they want to buy more stock, maybe they should sell their stock now, or should they just hold the stock. One of the most common ways to evaluate the stock price or the affordability of a corporation is to look at its earnings per share. Earnings is net income. Per share is the number of shares that are outstanding. So if we look at the net income that's available to the common shareholders and divide that by the average of the common shares outstanding, you get a measure called earnings per share. How much is the net income per share of this company? Once again, you could compare different sized companies. It doesn't matter how much the net income is. This is equating earnings on a per share basis. Now, it's not quite as simple as it sounds because we're only looking at the common shareholders, the people who own common stock. So one of the first things we're going to do is take the preferred dividends out of net income. See, the preferred dividends are going to be paid out of net income first, but that's going to be paid to the preferred shareholders. So to look at the net income that's available just for the common shareholders, it's very simple. You take the net income minus the preferred dividends. But how do we know what day we should look at for the number of common shares that are outstanding? Doesn't that change every day? It does. So we've come up and we've decided to just use the average of the common shares that are outstanding. And once again, a very simple formula. Take where you started, add where you ended, and just divide it by 2. And that would give you the average common shares outstanding. Earnings per share is important because shareholders want dividends, and dividends are paid out of earnings. Earnings per share is important because shareholders are also looking for stock price appreciation, and one of the main reasons that a stock price will go up is because the earnings are going up. Earnings are the basis of dividends and stock price. Another ratio analysis that deals with earnings is called the price-earnings ratio. So we're not looking at the earnings per share, but we're looking at the price per share compared to the earnings per share. So we're taking this earnings per share that we just calculated before and not just looking at just the earnings per share, but comparing that to the market price per share. In other words, how much are we paying per share compared to how much are we getting per share? So this shows the relationship between market price and the earnings, but on a per share basis. Compare the price per share to the earnings per share. This is called the PE ratio. If there is a high PE ratio, we can say the stock is selling at a premium compared to its earnings. This will happen because investors expect future earnings growth. So we're willing to pay a little bit more on a per share basis now, hoping, thinking, planning that the earnings will continue to grow. We're going to pay more than it's worth now because we are hoping, predicting that it's going to be worth more later. One of the other reasons that investors invest is to get dividends. A dividend is when a corporation will pay out some of the earnings to the shareholders. There are a group of people out there who that's what they invest in. They're dividend investors. So dividend investors are looking for dividends. However, you want to be careful that a company's not paying out too much of their earnings in the form of dividends. If they are, they might not be able to take advantage of some opportunities, and we might have to worry if they're going to be able to continue to pay out dividends. So we're looking for a company that has steady earnings. And if they have steady earnings, they should be able to pay out dividends when their profit growth is limited. So is retained earnings when the prospect of profit growth is good. So when profit growth is limited, we're going to pay out the dividends. when profit growth is good, keep that money in the business so that you can take advantage of those opportunities. So what percentage of earnings are paid out as dividends? So dividends per share compared to the earnings per share. There's really no right amount here. Everybody has their own opinion of what a good amount might be. But you do just want to make sure that they're not paying everything out, all their earnings out. So, you're definitely not looking for a dividends per share ratio of, 90%. If we're going to compare it to anybody, we're going to compare it to similar companies and see what similar companies do. Similar to the dividend payout is the dividend yield. Yield is what you get. So what am I getting for what I paid? What are my dividends per share compared to my market price per share? So this shows how a dividend compares to the market price. How much do I get compared to what I paid? This is the rate of return, but just when you're looking at dividends. So what am I paying for and what am I getting out? This does not take into account price appreciation. A low yield is neither bad nor good all by itself. So just because there's a low yield doesn't mean it's a bad company to invest in. Another ratio that stockholders look at is called the return on total assets, but we have to look at the after-tax return. You see, interest expense will lower net income, but then we get a tax break on our interest expense. So what we're going to do is we're going to add back what we call after-tax interest expense. So net income plus the after-tax interest expense divided by our average total assets. A little complicated here, but if you take the interest expense times 1 minus the tax rate, you're going to get your after-tax interest expense. So net income plus your after-tax income expense divided by your average total assets is going to give you return on total assets. Similar to what we did before, in order to calculate our average total assets, similar to what we did with shares outstanding, we're going to take the ending assets plus the beginning assets and then just divide it by 2 to get an average. So how much do you make with what you have? What is my return on total assets? Assets are what I use to make money. Return is the amount of money I make. So how much am I making based upon what I have? I said before we're going to add back the interest expense back to the net income. So this takes any interest payments out of the equation. We don't have to worry about, what do we do, how much are we borrowing in order to make money? Take that out of the equation and just look at how much are you making with what you have. This allows comparisons between companies with different debt levels. Another ratio we look at is return on common stockholders' equity. Once again, it's just common stockholders' equity, so we have to take out anything that relates to preferred stockholders. Return is net income, so net income minus preferred dividends divided by average common stockholders' equity. Average common stockholders' equity is the average total stockholders' equity minus the average preferred stock. So how much did you make with what you invested? How much did we make with what we invested? Financial leverage is an interesting concept. This is similar to kind of what we just talked about, but it's about using other people's money. We know that we're going to borrow in order to make money. So what we're looking at here is what is the rate of return on our assets compared to what is the rate that we pay to our creditors. If the return on assets is greater than our after-tax interest rate, then we say we have positive financial leverage. It's okay to borrow money to make money as long as you're making more than you're spending, and financial leverage is a measure of that. If the earnings slip, though, then your leverage can become negative. So we were borrowing money, we were making money, we were making money, we were making money. All of a sudden, we're not making as much money, but we still have to make the interest payments. So if you have negative financial leverage, it really means that you're paying more for your assets than you're making on your assets. The last ratio we're going to talk about is called book value per share. If you think book value, I want you to really think about assets minus liabilities. What do we own minus what we owe. If you take your assets minus your liabilities, you get stockholders' equity. Once again, we're going to take preferred out of the equation here. So we'll take your total stockholders' equity minus preferred stock and divide that by the number of common shares outstanding. So this shows the liquidation value for a common shareholder. What is this worth if we liquidate the company? If we compare that to the market price, and we can see some future expectations. The market price per share should be higher than the book value per share. We would expect that because the company is really worth more than its book value.